the very next session that we are doing will also be a huge surprise to a lot of people. We are talking about P2p lending, person to person lending, how it works. It'll be a great session. Let me tell you a bit about the speaker, Mr. Gautam Adukia. He's the famed co-promoter of the famous company Rentomojo. Liquiloans, of which he's also again a co-founder, is the company which offers this P2P lending. It's a very powerful way of investing a small part of your investable surplus. Now, what exactly is it? How does it work? What kind of companies are there? What are the risks involved? What are the rewards involved? That is what Mr. Gautam, who has very kindly agreed to come on board our platform today, will be giving out to you. Mr. Gautam?
Yes, sir.
Please come
Am
on.
I audible clearly?
Come on with your video, please.
Sure.
Yeah.
Am I audible clearly, sir?
Great having you here. And as we discussed, most of our people who are here on Facebook Live as also on Zoom may not have heard of this very, very special investing avenue. So I'm very sure, knowing your credentials and the way you have raised this great company, I'm very sure that you would be putting us wise on this avenue. Thank you.
Sure. Am I audible clearly, sir?
Yes, please.
Great. So firstly, thanks, Sanjeev, sir, for setting this up and allowing us to interact with the audience that you have. And to the audience, I would, before we start, would like to sincerely thank all of you all for your service. I will simultaneously share my screen so that the presentation is visible to you all. And while I go about it, if I'm going either too fast or if I'm either going too slow and then becoming boring, please feel free to message Sanjeev sir, and he relay the message to me, and I'll accordingly vary my increase or decrease my pace. I will start off with a quick background about myself and the company, and then go on to whether this asset class actually makes sense for you all as an investor or not. So quick background, my name is Gautam Adukia. I was born and brought up in Mumbai, did my graduation in Mumbai itself. And post that, I went to do my MBA from IIM-Calcutta. Post graduation from IIM-Calcutta, I joined IIFL Wealth Management, which is probably the largest wealth management company in the country and one of the only pure play listed firms in that space. Worked with them for about 4 years, and then went about setting this company called Rentomojo. Rentomojo is an online platform for rental of furniture, appliance, bikes, laptops, phones, etc. Primarily catering to the millennial audience, right? So unlike in the past when people would stick with a company for years and work with them for 20 to 30 years, the millennials these days change jobs very frequently. So if someone like me whose family is in Mumbai has shifted to Bangalore for a job, I would not want to own a lot of furniture and appliances and keep relocating them every time I find a new job and keep shifting. We provided an alternative way which was very, very convenient for some of these users, which was to actually just rent furniture from us for a period which was equivalent to their rental period with their respective landlords, and return the furniture as and when they moved out of that apartment. So that company did really well. It's in the 5th year running, and around like somewhere around in that journey, we got the idea of doing Liquiloans as well, which is into peer-to-peer lending, because that industry was just about shaping up around late 2017, early 2018, and that's when we decided to move out and start Liquiloans again. So now about the industry, I'll actually break the presentation into two parts. First is I will just focus on how this industry has evolved, so you all have a context of the history of the industry and the evolution of the industry, and then delve more deeper into like Sanjeev sir mentioned, into the risk as well as the rewards that one should expect from this asset class as an investor. So quick background: this is a fairly new industry in India. Having said that, I'll just take a minute to actually go back into lending itself. So lending as an industry has been around for 4,000 years, right? Or probably longer. When in the very early days, this was simultaneous when barter system existed. Farmers would borrow seeds and grains from other farmers or from other individuals and repay them in some other format in the form of livestock or the final produce. So at probably around 4,000 years back, there was some format of peer-to-peer lending already happening. But similar to barter, the barter system itself, it had its own set of constraints. So what that ended up into is setting up of say formal banking institutions as we see them now. And the first set of banking or lending institutions came about in Italy in the 14th century itself. A good amount of boost to the banking system happened with the industrial revolution around the late 17th century, early 18th century. Because the amount of trade between within the country as well as with different countries increased exponentially as a result of the industrial revolution, which led to gave a huge fillip to the banking system itself. Quickly on to consumer lending itself, there have been very few innovations in the consumer lending industry in the last century. The first one was around the late 1950s, early 1960s, with the introduction of the credit card. In the US. 1990 saw the advent of the very early advent of online lending, where at least part of the process of taking a loan, instead of going to a branch, meeting a branch manager or meeting the credit officer, you could make the application online. The firm would start processing it and so on. And the 2000s saw the advent of alternate lending and specifically peer-to-peer lending. So we've actually come a full circle where we started 4,000 years back, and people who lend to each other ran into physical constraints of only knowing a few number of people, and now all the way back to 2000s where we've gone back to a similar system where people are now allowed to lend to one another directly via an online platform. So P2P industry has been around for the last 10 or 15 years. The origination of the industry is a fairly interesting story, and I had the good fortune of interacting with Mr. Renaud Laplanche, who was the founder of Lending Club. That's one of the largest P2P platforms in the globe, located out of the US. So Zopa in the UK and Lending Club in the US were the early pioneers or the early starters of the P2P industry. And Renaud, who was the founder of Lending Club's principle was very simple, right? In the US, he realized when people saved money or put it into a bank in a fixed deposit, they would earn 1%, 1.5% back then. And when they would go back to the bank and borrow money as a personal loan or on their credit card, they would be charged 8 to 10%, or on a credit card closer to 20%. A similar construct exists in India as well, right? When we go to say an SBI or an HDFC, you get 3.5%, 4% on your savings account. You probably in today's world get 5% on your fixed deposit. But if you go take a home loan, it's at 9 to 10%. If you take a personal loan, it's anywhere between 14 to 18% and so on. So that's a very, very wide spread between what you earn as a saver and when you go as a borrower to the same bank, you pay as a borrower. So that sort of gave an opportunity for P2P platforms to initiate, where they said now that you don't require branch banking, the entire concept of taking a loan can be automated. You can do practically 80 or 90% of the process online. Similarly, for savings, you need not go to the branch and deposit cash or deposit a check. You can invest online. Why do you need bank branches and the costs associated with that? You can actually remove that entire intermediary, make the process very, very seamless and operationally efficient, and by extension pass on the benefit to both the borrower and the saver. Again, a fillip to the P2P industry happened because of the 2008 crisis, where banks had become very, very cautious. They didn't want to lend out money to even the high quality borrowers, and therefore that sort of gave an opportunity for P2P platforms to initiate or increase their business. Globally, like I mentioned, Zopa is one of the largest players in Europe. Lending Club and Prosper are the two largest players in the US. So Europe and US have seen the rise of very, very large companies in the P2P lending space. China has had a mixed experience where it flourished quite a bit, and then because there were some fraudulent players, the industry saw a downturn at that point of time when regulators came in and said we would want to regulate the business. Some of the reports estimate it will be a $100 billion plus disbursement industry in the next 3 to 5 years. It's already, as we speak, closer to about 70, 80 billion. So it's actually become a very large percentage of at least the consumer lending market in countries like US and Europe, where because labor costs are very high, it is not feasible to actually have a branch banking system for retail credit, which are small ticket size loans. In India, actually, P2P lending again has existed for decades, right? So a lot of us would have either borrowed money from a friend or lent money to a friend or a family member. There's a fairly large community lending market in the Gujaratis, Marwadis, Sindhi community where people lend large amounts of money. In fact, even the humble kirana store, right, where a lot of the families have a month-end credit system. They keep using the product or purchasing products on a monthly basis throughout the month, and then settle the account at the end of the month. That in a way is also a format of P2P lending. But some of the more formal organizations started around 2000, 2012, 2013. Unfortunately, a lot of them they didn't see as much traction because of two functions, right? So a lot of the lenders were skeptical because it wasn't a regulated industry and a very new asset class at that point of time. Simultaneously, the kind of borrowers that were attracted to the platform were typically either medium or low quality borrowers. So the amount of default that you saw when money was lent out to such borrowers was slightly higher than one would expect, and therefore the industry didn't gain as much traction as one would have liked. Around October 2017 is when RBI came in and said we would want to regulate the industry and set out a list of guidelines which any P2P lending platform needs to follow if they want to operate in the business. And that again has given both a recognition to the industry as well as sort of acted as a catalyst for the growth of the industry, because now it's being regulated. A lot of the players have a clear visibility in terms of how the business would function from here on. So how does P2P lending work? It's very, very simple. A lender is lending money directly to a borrower with the help of the platform. The platform does two or three functions primarily. One, it evaluates the borrower. So the platform will look at the credit bureau score of the borrower, look at the kind of past loans that he's taken, what has been his repayment track record, has he defaulted a lot or has he paid all of his loans on time, do a physical verification if required, look at his employment records and see which kind of companies he's worked for. So based on some of these factors, arrive at a rating for the borrower. Is he a high quality borrower, a medium quality borrower, or low quality borrower? Again, different platforms would use different criteria for this. The platform would again facilitate the signing of either an online or an offline loan agreement between the lender and borrower to facilitate the transaction and make it formal, as well as do the collections. So the hardest part in the informal lending industry was doing the collections. If you all lend, and as we would have seen when we lent money to a friend, we always face hesitation in asking the money back. Since the platform takes the responsibility here, for the lender it's as simple as investing money in any other asset class and then just tracking his portfolio over a period of time rather than actually getting into the operational process therein. So what is the use case? So I'll just focus a lot more on the borrowers currently and then move on to the lenders to the rest of the presentation. For borrower, there are 3 or 4 major advantages. Because all of these platforms are online, the turnaround time or the amount of time it takes to either accept or decline the loan or approve or decline the loan is much faster. The entire process can happen online, and therefore the borrower doesn't have to go to a branch and speak to a bunch of credit managers. He also gets the benefit of a lower interest rate because now there's no intermediary, right? There's no bank or an NBFC in the midst who's actually adding on their cost as well as profit margins. He's borrowing directly from the lender, and therefore to that extent, there's a possibility of him getting a lower interest rate. I'll just again move on further in the presentation and get deeper into the lender's perspective because that's something that's more relevant to the audience here. So from a lender's perspective, it's a fixed income asset class, right? And fixed income is something which is a staple for investors across the curve. At IIFL, we used to manage portfolios for very high net worth individuals. And with my experience, I've seen even for small investors all the way up to high net worth investors, typically the allocation to fixed income is higher because as Indians, we're generally more cautious in our approach. Equity, in spite of all the literature around it, is only slowly gaining momentum or in a higher percentage share in all of our portfolios. But fixed income continues to remain the mainstay. As you can see on the rightward graph, almost 70%, more than 2/3 of all financial assets are invested into fixed income instruments. But within fixed income, there are 2 underlying asset classes. One doesn't necessarily peer through when investing, but actually the fixed income comes from lending either to retail borrowers or to corporate borrowers. And the banking system level, almost 2/3 of the entire loan book that has been lent out till date is towards corporate borrowers who are large companies, mid-sized companies, and so on. And retail, although growing much faster, as you would see in the last couple of years, still accounts for less than 1/3 of the overall lending that the banks and NBFCs till date have done in the country. Now, what we'll do is just compare both of these underlying asset classes, which is how does corporate debt compare with retail debt, basis various parameters. So the first point is diversification, right? And this is fairly linked to the average ticket size, because the amount of exposure that a bank or NBFC takes to one corporate is generally high. So you would see loans all the way from 50 crores to 100 crores, 500 crores, going up to 5,000 crores for something like for a company like setting up a large power plant or a very large steel factory. So because ticket sizes are so high, the diversification is very low. Whereas in retail debt, a home loan would go up to a maximum of 2 or 3 crores. You would see personal loans not more than 10, 15, 20 lakhs on an average. So since ticket sizes are so low, the average exposure to one borrower is very, very low. And therefore, if something wrong were to happen with one single borrower, the impact to the lender or to the NBFC is fairly limited. Whereas if it does happen very infrequently, but let's say, as we've seen in the last couple of years, a spate of bankruptcies have happened. If say Abhushan Steel goes bankrupt, suddenly the impact that the lender might face if there are no recoveries is to the extent of 5,000 crores, is to the extent of 2,000 crores in certain cases. So since diversification is low and average ticket size is high, that becomes a slight concentration risk. Secondly, the borrower leverage, which is the amount of leverage or total loans that are there on the balance sheet of a corporate as a percentage of the equity that they have or as a percentage of the net worth that they have, is generally much higher than a retail borrower, because the retail borrower is either allowed to borrow against his assets, which is either a home or a car, or in case of a personal loan which is unsecured, the amount doesn't exceed 10, 15, 20 lakhs or 30 lakhs or 50 lakhs in most cases. So it's again a small percentage of his net worth as compared to corporate borrowers where the percentage of the leverage is much higher. Now, underlying risk is the set of factors which actually impact the probability of default. In most retail borrowers who are salaried, there's only one element which will impact their probability of default, which is his salary. Either his salary decreases or he loses his job altogether and therefore is unable to make the repayments that he has signed up for, which generally is a fairly diversified and a minimized risk. But in a corporate, there are a bunch of things that could impact the corporate profitability. So it could be oil prices going higher, it could be government taxation changing, it could be the market landscape changing, Amazon entering the industry, and whatnot. So since there are so many factors that could impact a corporate's profitability and by extension his ability to repay, the underlying risk that one takes with the asset class is fairly high. One area where the corporates stand out is the intention to default. As long as the company is a going concern, typically there is a very strong moral barrier for them to not make the repayments if they have the ability to do so, because they will suddenly be dragged into bankruptcy. In retail borrowers, that's slightly sketchy because there you will find some fraudulent borrowers who will come onto the platform or who will take a loan from a bank and would suddenly disappear. And because the amount of ticket size is so low, it might be hard to or may not be worthwhile to even track him and recover that money. And so some of these risks are pointed out, but these actually play out in the bank's loan book as well, as we would see on this slide. So the first column here highlights the NPAs that most banks have seen on their retail book. As you would see with the same set of banks, the NPA on your retail book for SBI is 4%, whereas the corporate loan NPA is about 11.5%. For ICICI Bank, it is 3% on retail versus 17% on corporate. HDFC and Kotak again have fared much better in both the asset classes. But on an average, we've seen 2.3%, and as I've listed down, you could see these are some of the best organizations. The ratios would probably be worse for the other entities that one could look at. So for retail, we've seen a 2.3% NPA on an average versus 8% for corporate. And the same number has played out for even the last 5 years, where retail NPAs have been 2.14% and corporate NPAs have been 7.4%. So inherently, not just in India, but globally, because of some of the advantages that I've listed down here, which is highly diversified borrower base, tenures are shorter, your loans for retail borrowers apart from home loans are for 3 to 5 years and corporates are much longer. The retail borrower actually pays EMI, which is principal plus interest on a monthly basis, whereas some of the corporate borrowers pay just interest on a monthly or an annual basis and then have to pay back the principal at the end of 5 years or 7 years, as the case may be. So some of these factors ensure that retail defaults are generally across the curve lower, even in a bad credit cycle like the one that we're seeing right now. Now, within retail, P2p platforms are specifically allowed to do only unsecured loans. And the first conclusion that people jump onto with unsecured loans is that they're very risky, right? If I'm lending without a hard collateral like a house or a car, what happens if the borrower defaults? I have nothing to take back as collateral and sell or auction in the market and recover my money. But in spite of that notion, if you actually go by hard facts or figures, as you would see in this bar graph here, The NPAs that banks and NBFCs have seen on their home loan portfolio is about 1.68%. On their auto loan portfolio is 2.66%. And on their personal loan portfolio is 0.63%. Now, this is very counterintuitive, right? How is it possible that people are not paying their home loans and auto loans, but are paying their personal loans? So our sense is this is happening probably due to two functions. One is the underwriting criteria or the evaluation process for home loans is much more liberal than personal loans, because the bank or NBFC knows that a personal loan is unsecured. The criteria that they use are much more stringent than a home loan or an auto loan. Having said that, the flip side of this is in the 1.6%, 6% default that a bank would have seen on the home loan, they would at some point of time, if the borrower is a continuous defaulter, repossess the house and sell. So their losses would be much lower than 1.68%, but it would take anywhere between 3 to 12 months for them to be able to repossess the property and auction it. And it's an operationally intensive process. But the point I'm trying to drive here is that even unsecured loans as a category, as long as you restrict yourself to high quality borrowers, is a fairly safe asset class, and 0.60% is a fairly low default ratio at an overall level. Yeah. In fact, to a certain extent, you have already taken an exposure to retail borrowers, right? So when you park an FD money with a bank as an FD at 5% or 6% in today's time, the bank is onward lending to some of these retail borrowers at anywhere between 9 to 20%, depending on the nature of the loan and the quality of the borrower. So by extension, although you have taken a indirect exposure, by virtue of the fact that it is indirect and the bank has a huge operational cost, the returns that accrue to you are much lower. And same is the case even with a debt MF. When you put money into a debt MF, part of that is lent out to NBFC firms, and some of those NBFC firms will be lending out the same part of that capital back to retail borrowers at a similar cost of borrowing to the borrower. So again, due to the fact that you're taking indirect exposure and there are one or two intermediaries in the entire value chain, the return to the investor is much lower in spite of taking the same underlying investment risk. The solution to a certain extent is the P2p platform, where we say, as you see in the traditional lending structure, you put money in a bank at 5%, the bank has a markup, lends money, say, to an NBFC at 10 or 12%, the NBFC further marks it up and lends to the borrower at 15 to 18%. All of this can be operationally, the cost of operations can be reduced meaningfully using an online format where both the borrower and lender are meeting through the online platform. The borrowing cost to the borrower is lower, and therefore there is high incentive to pay, as simultaneously the return to the investor could potentially be much higher than some of the alternative debt products that are out there in the market. So I've given you a list of the benefits or pros of investing into P2P, but it is much more important to spend time on all of the risks that exist in the industry before even allocating a single amount of rupee in the industry. So the first and the largest risk is actually the fact that it's still a relatively new asset class. Mutual funds have been around for 25, 30 years. P2P at the maximum in the country has been around for 7 or 8 years and has gained traction only in the last 2 or 3 years. So to that extent, both the track record of the platforms as well as the asset class is fairly limited, and therefore the exposure, if an investor so desires, should be capped at a very small percentage of their portfolio. One shouldn't ever allocate a very large percentage of their portfolio to an asset class which is as new as this. Again, although I've highlighted unsecured lending to high quality borrowers is fairly safe, but by virtue of the fact that it is unsecured, in case there's a default, there will be absolutely zero recovery from the borrower apart from any voluntary EMI payments that he makes. One of the other issues in the industry is credit underwriting is a fairly specialized skill. Not all lenders would either have the intent or have the time or the capability to assess each borrower's profile or each borrower risk accurately, and therefore someone who is not completely conversant with the underlying risk should ideally stay away from the asset class. Another risk is that there could be a high level of NPA if the borrower quality sourced by the platform is poor. So a lot of the focus, similar to when we invest into mutual funds and try to select a good fund manager, has to be placed on the platform and the quality of borrowers that they are sourcing, and ensuring that the money is diversified across a large number of borrowers. If the underlying quality of the borrowers is poor, no matter how good the collections process of the platform is, they will not be able to make a lot of recovery. And therefore, even though it's a fixed income asset class, there's a possibility that you not only lose your interest, you also lose the principal that you've invested and therefore the asset class has to be approached with a greater amount of caution as compared to most of the other asset classes out there. A key risk, similar to what I've mentioned with the corporate versus retail, is lack of diversification. If, for example, you invest say a lakh of rupees and you lend it out to just one borrower, then the outcome is binary. Either you make the interest rate that the borrower pays, or you could lose entire principal. The beauty of the retail asset class came from the fact that it allowed you to invest in a diversified portfolio. And unless you follow that principle, basic discipline principle of ensuring that the underlying portfolio is widely diversified, the risk may not be, the risk return trade-off may not be something which is very positive for the investor. Again, because ticket sizes are smaller, it is operationally intensive for both the platform as well as the investor to spend a lot amount of time. So that leads to some amount of operational difficulty additionally. I will also try to highlight some of the ways that you can, you or the platform can mitigate some of these risks. So as you see on the top, there are credit rating agencies similar to CRISIL, which does credit rating for corporates, where they classify corporates all the way from AAA, AA plus, AA, all the way up to a D rating for the corporate that defaults. The credit rating agencies for individuals rate individuals from a scale of 300 to 900. 300 to 600 is considered the subprime category or the low quality borrowers. 600 to 700 is considered medium quality borrowers or near prime. And prime is the category which is classified as high quality borrowers who generally have a credit score of 700 to 900 on the scale. So the idea, the one way to mitigate all of the risks that we mentioned in the previous slide is to target just this quadrant or this part of the pyramid, which is high quality prime borrowers who are scoring 700 plus on an average on their credit bureau score. One way to do this, or something that we've tried at least on our platform, is to approach them via 0% loan. So if any of you all have come across a Bajaj Finance loan at say a Chroma or some of these electronic goods outlets, where if you walk in, there's a salesperson there who says you can either purchase a laptop today and make the entire 50,000 rupee payment today, or you can take a loan from Bajaj Finance and convert it into 10 EMIs of 5,000 rupees each. So you're paying the same amount in either case, 50,000 at one go today, or 5,000 into 10 installments over the next 10 months. Now the second option actually becomes a no-brainer if you get approved for the loan. So even though an individual didn't necessarily walk into the outlet with the idea of taking a loan, because the loan was so attractive at 0% incremental interest cost, it becomes a no-brainer. Now, if you are willing to make the 50,000 rupee payment upfront, there is very limited reason why you would actually default on the loan since it was at 0% interest. So some of the things that we do to also understand the borrower better is analyze his entire credit history. What kind of loans has he taken? When has he taken those loans? For what purpose? Has he paid them on time? Has he delayed on some of them? Does he have an intent issue? Does he have an ability issue? What kind of firm is he working for? Is he working for a large company in a high designation, or is he working for a small firm? What kind of expenses does he do? So a lot of times, depending on ticket size, we would analyze his bank statement and understand the nature of the expenses. How much does he save? How much does he invest on a monthly basis, to arrive at a conclusion of whether the borrower is a high quality borrower or not. Typically, as a platform, tend to stick with only the high quality borrowers, so that although the returns might be lower with that category, the risks are meaningfully lower. And this is the construct that we follow. We partnered with a lot of service providers. Anyone walking through or entering an outlet of the service provider is provided with an option of a 0% loan. So even though they walked into, let's say, an outlet with the intention of either purchasing a product or consuming a service, some of them will voluntarily opt for the loan because of the fact that it was at 0% and it was no-brainer. You invest that money into a liquid fund or a debt mutual fund, and over the course of the next 10 months, you could potentially earn 3-4%. So it becomes a smart way of generating incremental capital for the borrower. So out of all of the 100 borrowers that would typically come, you would select the top 20 and reject a large percentage of those 100, and only those would be listed on the platform. And the investor can then accordingly select or choose to invest in a diversified portfolio of these borrowers. So you need not lend to only 1, 2, or 3 of these borrowers. We would ideally want you to lend to in small chunks to 200 of these borrowers. So your risk at a borrower level is minimized or mitigated to the maximum extent possible. Right. And again, as an asset class, there's a high amount of transparency because it's a completely online asset class. You are provided with a live online dashboard which lists down, granular allocation of your money. Even if you invested, say, 1 lakh of rupees, exactly where is that money lent out, to which borrower, where does the borrower work, what is his age, what is the credit score of the borrower, what is the tenure of the loan, what is the purpose of the loan, what is the monthly salary or income of the borrower, what is the total amount that is borrowed, how much have you invested as part of the loan, and how is the loan performing. So since all of these details are available on a live basis at any point of time, you can go back and track your investment. I'll just quickly conclude with whom does this asset class suit, and why should you invest. One is because it's an uncorrelated asset class, right? So even if equity markets are very bullish and are scaling new highs, or actually in a bearish market where equity returns are decreasing day on day, this asset class will remain largely unimpacted. There's a very low correlation to either the equity or the debt market because retail borrowers, irrespective of corporate profitability, will keep earning their salary month on month and will keep making their monthly repayments, EMI repayments on an ongoing basis. And therefore, because the true source of diversification, which is uncorrelated to your asset class, similar to gold, it begets a small allocation in your overall portfolio. Again, within the asset class, you should stick, like I mentioned, only to high quality borrowers, people who on an average have a 700 plus credit score. Lend to a diversified set of borrowers and ensure that your average exposure per borrower is very, very minimal. So the ideal allocation that we recommend is 200 borrowers, which is almost 5x to 10x the diversification that you see in any other asset class. If you pick up a high quality debt mutual fund also, will typically have 20 to 40 names, and therefore a 200 borrower portfolio is a much higher level of diversification, thereby safeguarding the portfolio in case something untoward were to happen. And again, because because the funds flow through an escrow structure where trustee is managing the fund, there's absolutely no counterparty risk to a platform. So even though we are a 2 or 3 year platform, there is no risk that you're taking on our existence or our performance as a platform. The only underlying risk is how the underlying set of borrowers perform at any point of time. Who shouldn't invest in this asset class is as important, and who as the reasons to invest is one, people who are not who are completely risk averse, right? So if you're not willing to understand the entire category, or you typically have a low risk threshold, it's a new asset class. As much as we try to mitigate the risk, there is still some element of risk which will remain in the asset class, which will play out only over a period of time, and therefore you should invest only either a small percentage of your portfolio or not invest at all if you have a particular risk threshold in mind. Similarly, people who are not willing to track this on an ongoing basis because it's a new asset class should avoid investing on the platform. Sanjeev sir, so that's a quick summary from my end. Happy to take questions if any.
Okay, right. Thank you very much, Mr. Gautam. This is a very good presentation and questions have come in. The first question, that is, what is the kind of rate of interest that we can expect in this investing?
Sure. So the rate of interest actually varies depending on the nature of the borrowers, right? So I would just give a context to the answer before I come to the exact answer. Similar to equity mutual funds, where you have large cap mutual funds, mid cap mutual funds, and small cap mutual funds, and all of them have different return thresholds or return expectations and risk thresholds. Depending on the nature of the borrower that you are lending money out to, your risk return could differ. So some of the low quality borrowers could end up even borrowing at 24 to 36%. The medium quality could be between 18 to 24%, and the high quality borrowers would typically want the lowest interest rate because similar to all of you all and me, we keep getting multiple calls from a lot of our bankers on an ongoing basis that a loan is available. So they look out for the best pricing in the loan. The return expectation from high quality borrowers should not be more than 10-12% if you do invest your money.
Okay. Then second question is that in case there is a default or something, then how are the lenders protected in any manner?
Right. So I'll just again take a step back and say, what do we do in case of a default? In case there's a delay or default, the platform tries its best to recover the money. So not only will we have we as well as the other platforms have an in-house collection team who will keep calling the borrower and trying to recover money. You also have outsourced agencies who will visit the borrower if need be and try to collect the money from his location or from his office, as the case may be. And then we also impact the CIBIL. So because we're an NBFC licensed by the Reserve Bank, we're allowed to impact the CIBIL of the borrower. So if he doesn't make his repayments on time, or he delays or defaults on his payment, we will keep reporting that to the credit bureaus, and by extension, his credit rating or the credit score will keep declining. Depending on the structure or the agreement that the lender has with the platform, the risk the impact that they may face due to a default might vary. So it's a very tactical answer depending on the platform that you've invested at and the impact of the default event.
Okay, right. Thank you very much, Mr. Gautam. Now, there are a few other questions also, but because of paucity of time and the other speaker is already waiting. So the only thing that remains for me is to thank you very much for telling our viewers about this novel way of investing, and in a very, very professional manner. Really grateful to you for taking your time out and joining us on this platform. Thank you very much.
Thank you, sir. Thanks, everyone.